Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
So greetings, everyone. Thanks for coming back to my seasonal methodologies, to my seasonal podcast, or whatever you want to call it. It is the 22nd of October at 2:05 p.m. where I am in the Santa Cruz Mountains of California. As you know, seasonality is near and dear to my heart. I've been using it for over half a century. Interestingly enough, even though I tell people I started trading in 1967 in the summer, and I say it's been 52 years, someone so correctly pointed out to me that it's really been 57 years. I hate you for doing that. But the fact is, it's been a long time. If you can't learn something from me about seasonality, how it's used not only as a beautiful concept, but also as a great trading methodology, then you won't be able to learn it from anyone else, because I've been there and done it many, many thousands of times over. I'm going to start today with what might seem to you to be a little off topic, but you'll see that I'm going to get to my point very quickly. Many people don't know that there's more than one theory of evolution. Most people are familiar with Darwin and his work, and take as gospel the Darwinian theory of evolution, unless, of course, you're a creationist and believe that there was no evolution, that people were just created by a divine entity. There's another form of evolution scientifically called Lamarckian evolution. Most people never heard of it. Jean-Baptiste Lamarck developed the theory, and there are some significant similarities and differences between the two theories, and I'll get to my point very quickly. In Darwinian theory, it's survival of the fittest. It's that traits of survivors are passed on to their generations and their offspring, and that over time, the weak ones die off and the strong ones live. Lamarckian evolution is very different. Lamarckian evolution talks about the acquired genetic traits. In other words, why does a camel have wrinkles and calluses on its knees? The Darwinians would say, because those camels who did kneeling for their masters and were weak eventually died off, and only the ones who had calluses and could withstand the pressure remained. And that's how it happened, and of course took many, many thousands of years. Lamarckian evolution is different. It says that if an individual or an entity has, for example, some damage in their life, that damage can be permanent and passed on to their offspring. So, for example, if you took some fruit flies and you colored their eyes blue, it's possible that the next generation of fruit flies would have blue eyes. Only Darwinian evolution survived. Lamarckian evolution did not survive, and there are many examples of Lamarckian evolution, but the reason it didn't survive is there weren't enough examples to support the theory, or there weren't enough experimenters to look for examples to support the theory. And the example that I gave of Lamarckian evolution is just a very weak example. There are many others that are very strong, and you can look them up if you find the theory interesting. I bring this up because trading is similar. In trading, only the fittest survive. Is it possible that other theories of trading did not survive because they weren't researched enough? Well, the bottom line is there are many theories of trading. There's a Darwinian theory, only the fittest survive, or there's theories like the candlestick theory, or the market profile theory, which I talked about in the past. There's the methodology of the 50 and the 200-day moving average. Over time, many of these methods that used to be popular have died. the triple moving average theory, point and figure charting, candlesticks. Do you remember the time when there were candlesticks everywhere? People were giving seminars and webinars on candlesticks and saying, it's a harami, it's an engulfing line. We hardly ever hear that these days. What about traditional chart analysis? Head and shoulders, gaps, reversals, key reversals. People rarely talk about them anymore these days because they've been abandoned in favor of other patterns. Over time, patterns will survive or die based on their effectiveness and use in the markets and research. Seasonality is a distinct exception to the rule because it has been around for many years and it continues to survive because traders are proving it correct day after day after day. When I say correct, I don't mean every time. We know that theories are not perfect. Theories are not 100%. But I believe that the closest thing we can find to certainty is seasonality, which is a form of cycles, as you know. And remember that we're talking about seasonals being cyclical patterns that happen within the course of the year, of the calendar year. Now let's talk about something else for just a moment. Gamblers are very keen on statistics. If we consider trading to be a form of gambling, namely that we take risk in the interest of a particular outcome, we take risk in order to achieve a particular outcome, you need to have the facts to support the methodology. Take an example. I have shown you seasonals that have been going on for over 40 or 50 years. What are the statistics there? If we take a sample, 50 years of history, and over those 50 years, 45 of them have been correct. And if you take that statistic, 45 years, 50 years with 45 correct trades, that is a very important number statistically because statistically it means the probability or the odds of this happening by chance are less than 1 in 10,000, which is very, very important. I want you to think about what you have in seasonals compared to what other people have in the methodologies they're trading. Have we ever seen statistics for point and figure charting? Have we ever seen statistics for the 50 and the 200-day moving average? We haven't seen them because they're not good enough to show. So if you're using a particular methodology and it's frustrating you and you're losing money, ask the obvious question. Does it really work? How does it backtest? Backtesting is a very important issue, but there are ways to backtest. There are ways to rig backtesting. We'll talk about that some other time if there is time. But the bottom line is this. The seasonal methodology has been around for a long time. It's a survivor. You may say that only old traders use it, because maybe only old traders remember it. But the bottom line is, it gives you everything you need. Specific patterns, as I illustrated in the last several sessions. When to get in, when to get out, and most important of all, the ability to backtest it. Many methodologies that are not algorithmic, or in other words, specifically based on rules, are impossible to test. Therefore, they become market mythology, not market methodology. Please make sure you understand the difference. So what are we going to do? Let's try and pay some bills. Let's try and make some money. Let's try and put our knowledge to work. And remember, I'm not telling you what to do. I don't have control over your account. I don't know your financial situation. Only you know that. So you have to determine if this particular methodology, if these particular trades that I'm talking about today are right for you. Let's begin like we usually do with the seasonal chart that's showing here. This is a chart of 3M, and as I've told you many times before, we took the high of each year, going all the way back to the starting year and forward to the current year. We made the high of each year 100, we made the low of each year 0. So in other words, we normalized the chart. We removed every year that was different in terms of its trend, and we kept only the pure seasonal trend. So this is an exact seasonal of what the chart looks like in terms of the majority of the years. This is not statistical fudging. It's an actual statistical method. So for example, when the government announces seasonally adjusted employment, they talk about how they took each year and they turned it into a specific pattern, and we're showing only that pattern. So let's put our position ourselves right over here, which is where we are right now. Assuming that this year is the average or typical year, this is what we should see going forward from now until the end of the year. We're going to see how that turns out. But what we want to do is fine-tune it. And let me talk to you a little bit about what I call the look from above. Consider that you're an artist, or you're an art aficionado. You go to the museum and you take a look at the paintings and you see some beautiful impressionist paintings. Standing up close, all you see is dots. As you move farther away, you begin to see the full big picture. I don't want to sit up close and see dots. I want to look at the big picture from outside, like the James Webb telescope, and see the big, big picture. And then, once I find something in the big picture, like this, I want to zoom in and detail it and find the exact location of my buys and sells, which I can do very easily with Seasonal Trader. So what I'd like to do is, as I said before, let's make some money. According to the rules and the methodology that I've been teaching you, right over here, approximately the second or third week of October, we should begin to move up. How do we know that? The line plot is green, which means the trend is up. The plot itself is green, is up, which of course translates into a bull market. In addition to that, we've got some arrows at the bottom, which point to high probability trades in that direction. So during this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, during this approximate 12 weeks, we've got 1, 2, 3, 4, 5 weeks that are highly statistically probability of an up move. This may be good for some people who want the distant view, but I want more. And we do that by achieving a search very simply. So I'm going to go to the search mode. So here's the history of 3M. And this history covers that period of time that we've been looking at. You'll notice there's a trade there that goes from the 27th of October to the 9th, looks like the 8th to me, 8th of November. Not a very long-term trade, but certainly in terms of statistics, it's very impressive. It's had an accuracy of over 80% over the course of many years, 54 years to be specific. So that's one trade we can look at. And it's coming up at the end of this month. We will see how it turns out. If you've been coming back here regularly, you will see immediately what I've been trying to teach you. In fact, you will look at it and you will say, oh my goodness, I cannot believe this is incredible. And what is that I'm referring to? I'm referring to this right over here. Because in this case, specifically Alcoa, it appears that from approximately where we are in mid-November to the end of December, this stock encompasses practically the entire high and low of the year during this period of time. And certainly we want to see if we can make some money with this pattern. Remember, whether you trade this or not, it's an individual decision. But one thing you can do much better with seasonals than with any other method I know, you can go back and look at each year you want to look at and ask the question, is it correct? Is it real? Is it viable? Is it useful? Is it profitable? Has it been? Can we do it? And so, this is very dramatic. Again, as I said before, this is the big view. We're looking down from outer space and we see this thing and we say, unbelievable. What can I do to get in on this move? Well, first of all, we've got until mid-November before we have to make a decision. Second, we can go back to Seasonal Trader and run some numbers. Let me show you what I mean. Let me get back to it. Go to Seasonal Trades, US Stock Trades. Let's find it. Here we go. And I hope you remember the time frame. We're going to go to Alcoa. And before I show it to you, I want to address a very important point. Some of you may be thinking, well, you've done it now, Jake. You've spilled the beans. Everybody knows this trade now. And because everybody knows it, it's not going to work. I want you to think about the idiocy of that statement. If everybody knows it, it will work better. Why? Because if many people get in, it's a very strong indication of demand. The stock will make its move, whether it's justified fundamentally or not, and it will work better. The other side of the coin is this. If you believe that everybody will do this trade according to the rules, then perhaps it might not work. It might be anticipated. But the best thing you can do as a trader is not think about either one of those alternatives. What you want to think about is, does the trade interest you? Is it okay in terms of risk? Do you have the ability to risk on that trade? Can you find an alternative to the stock itself and perhaps just do an option? What is the strategy you're going to use? And what are the statistics about the trade that really show you what's going to happen or what should happen? Because when we look at the chart, we're just seeing the gross chart, as I said, from a distance. We want to dig in close now with a microscope. So we're going to go to Seasonal Trader, and we're going to go to Alcoa. And we're going to go to the right over here. We're going to say, we will risk 99%. What does that mean? If I put nothing in here, it will show me everything without a stop loss. We don't trade without stop losses. So I'm saying to the computer, show me all the trades. Use a stop, hypothetically, of less than 100%, so you can see all the alternatives. And let me cut away for just a moment here. Seasonaltrader.com was the brainchild of myself and Dr. Richard Smith of the Foundation. In fact, he deserves all the credit for having put this beautiful piece of work together. Because even in the last 15 or 20 years, however long it's been, we have rarely had to change anything because it's been working so well. But that's an aside, and that's a story for another day. So let's do this. We're going to go to the month of October. Actually, we're going to go to November because that's when the trade begins. We're going to say, for the month of November, I want to see every trade that you have in your historical database and what the results were, hypothetically, backtesting. So we're going to go here and we're going to do a search. And lo and behold, here it comes. We've got a trade that begins on the 20th of November, runs through January the 5th, with 83% probability. And here's the history. And you'll observe, we can do something here that the vast majority of traders cannot do, or will not do, or don't know how to do, because they don't have the history or they don't have the experience. Look at this vast database. It's truly unbelievable. And what happens? These are the results right over here, backtested. A slow and steady growth curve. Yes, there were some losing years, but overall, stellar performance. Now what could I do with this information? I can go back to the previous step and refine this and say, show me something better. Is there anything better? Let's find out. We're going to go back and do a little more research and say, perhaps we can hold this trade longer. Let's look at trades that are longer than 25 days. Why do I do that? I do that because the big money, as I've told many times, is made in the big move. Let's find the big move, if there is such a beast. Let's do a search. And here we go. And we did find some trades November 20th through January the 5th. But is it possible that we can do even better? Let me show you. Let's go back to the search, like so. And let's limit the information let's expand the information by looking at October, November, and December. Why do that? Because remember, the big money is made in the big move. And if you think back to the chart, you'll notice that it started in mid-November and went through the end of the month, end of the year. So let's begin actually in October and see if there's anything there. It doesn't cost us anything to do that. Let's remove everything here except for the stop and see what we get. Let's do a search. Well, isn't this interesting? Because by changing the search features a little bit and digging into that database, we've been able to generate the history on a trade that has been correct 90.7% of the time. And let me stop right here and say this. When things are this good, they usually don't last. I'm not saying to you that the same pattern will be repeated this year with 90% accuracy. Certainly there are many other choices. But the mere fact that something has existed with such high accuracy for such a long time is very impressive and speaks strongly to the survival of the fittest in terms of methodologies. Let's take a look. Here's the history. And we're looking at 54 years of history. And we're looking at something very dramatic. Because even after having been available to traders who are looking for seasonal patterns, to see something like this is truly amazing. Now remember, it's very important to understand the history of seasonality as a developing process. In other words, we just didn't find these out of the clear blue. We found them with research, and there are many ways in which you can do research, especially now with AI. You can produce research like this very easily and very quickly, so there's no excuse to not use seasonals. What else do we know about this methodology in this particular trade? Well, we know that the average profitable trade is bigger than the average losing trade, as you can see right over here. We also know that it's had 5 losers in 54 years, and these statistics there are very dramatic in terms of reliability. We also know that it's had a profit to loss ratio of 14-1, which means what? If you add up all the winning trades and you add up all the losing trades and you divide the sum total of the winning trades by the sum total of the losing trades, the average will be 14-1. In other words, it's made 14 times as much money as it's lost. Now, if this were the only instance of this kind of information, I would be concerned. But it's not. In fact, let's do this. Let's go back one screen to here, and let's return to the search. And let me show you something else. I'm going to clean this up right over here. And by the way, we're going to follow this up. We're going to remember what I said today. And when the time comes, we're going to see how it turned out. Remember, folks, no guarantees. Let's go to October, November, December. And let's go to Deckers. And yes, I picked this one before this session to illustrate as an example. Let me say one more thing. I am not interested in selling you a program or getting you to buy anything. I'm simply showing you a tool that I developed with Dr. Smith, a tool that I use and have been using for many years. There are many seasonal programs out there. There are at least several that I know of. If they don't give you this kind of information, they're probably useless. But this is the kind of information you need, not only for seasonality, but for everything you do as a trader or investor. Let's go to Decker's Outdoors. One moment, please. Here's Decker's. Let's go to the search. And what do we have? We have a 77% trade, not very impressive. But what I want to do is come back to the seasonal chart. I'm going to show you something. Here we go. Seasonal chart. And it should come right up any moment. Here we go. So let's look. This is the period of time that we looked at. But I want to look at something else. How about this 3-week period? How about this 3-week period? Could that be better in terms of performance? Let's check it out. These are the first 3 weeks of February. Let's go back to the search feature. One moment, please. And let's go to return to search. And let's just go to the month of February. So what I'm showing you is a process. And by the way, doing this kind of research is very enjoyable. And if you do a few hours, you'll be able to find some trades for the entire year that will serve you extremely well, assuming you choose the right way and follow some of the rules that I'm giving you. So here we go, February for Decker's. Let's make sure it's still checked. There we go. And let's see what we've got. And remember, we're looking at a very circumscribed period of time. All right. And here's the top trade. And by the way, the computer sorts these trades by putting the highest trade probability at the top of the list. Does this cover the period of time we're interested in? Yes, it does. Approximately the first 4 weeks of February, right over here. And let's look at some other numbers. The average profit per trade, the average loss per trade. Look at this. Percent average profit is 6.71. Percent average loss is 2.9. You can see the average profit is much better. And we sacrificed 3% in performance to get that result. But let's take a look at it. And again, as what I'm showing you is loosely called seasonal research. Here we go. And let's look at the history. Now, isn't that interesting? What does it say? It says that this one loss was so big, it erased a number of years' worth of gains. Remember, we have this information now before the fact. That's very important because it basically says steer clear of this particular trade because the possibility of this happening again. That is valuable information to have. It's the kind of information you want to have before you do anything, right? So, what are we going to do now? We're going to go back. We're going to look at it again and say, okay, this is nice, but not nice enough. How about this one here? From the middle of May to the beginning of June. No problem. Let's go back. Beginning of May to the middle of June. Come back to me. Here we go. From the middle of May to the beginning of June. So we're going to come back here. And what I'm basically showing you is how to do some research. And we still got Decker's checked off. So let's check the results. Here we go. Okay, again, it's an 83% trade. Percent average profit is much bigger than percent average loss. This is what we want to see. Let's find out if that one scary outlier is still there. Here's the history. And now we're talking. Check it out. This curve is parabolic. Last year was the second best trade ever. We still have a loser here, but remember, if you're an options trader, you can do a lot to mitigate that problem. Very, very simple and very easy to do. And remember, don't interpret the meaning of this curve. Don't look at it and say, it's gone parabolic. It can't continue this way. It has to have a losing year. It's been doing too well. It hasn't lost money in all of these years. Don't do that. The decision you want to make is based on number one, performance. Number two, can you afford the risk? Number three, is there a way to mitigate the risk and turn this into a better situation for you? Let me show you one more thing, and then we'll be done for today. Boo-hoo. Let's go back. 1 second, please. Let's go back to here. I'll show you a little trick. So here's the seasonal chart. And you'll notice we are trading for this little sliver of information right over here. You may be wondering, what is this red line going up? Shouldn't the color be green? Should it be like this? What does this mean? I will explain that in great detail in the next session. But let me show you something else. I'm going to click on this one time, and that should bring up the daily seasonal chart. And here it is. Look at this. These days, May 22nd, 23rd, 24th, 27th, we're going to research and report back to you what we found and what it means. So let me review. Today we talked about zeroing in on some trades. I showed some very high accurate trades. We looked specifically at an Alcoa trade, which may or may not happen this year. No guarantees. Percentages are impressive. We talked a little bit about survival of the fittest, a little bit about evolutionary trading. What I'd like you to do is think about what I said. Most of all, think about what you're doing as a trader. Are you using methods that can be tested back like this? Are you using methodologies that are specific and clear? If not, the odds are you're trading on intuition and gut feel. And if that's what you're doing, it's not going to work for you, even though it may be working for you right now. Thank you for being here. Thanks for the foundation. Thanks for allowing me to do this report for you. And I hope you're learning something from it. Let me hear from you. Thank you again.